Hey, what's up, everybody? It is the Weekly Multifamily Roundtable. We are at it again for yet another week. We're excited to have you. I am Anthony Vicino alongside my co-hosts Rodney Thompson and Dan Kruger. We are apartment syndicators. All of us happen to be out of Minnesota. And today we're going to be breaking down passive investing in apartment syndications for the complete newbie. This is a 3-part series. So if you've already missed part 1 and part 2, go ahead and pause your video, leave us. No, I'm just kidding. Stick around with us. You're going to enjoy this conversation. You can always cycle back later and watch the earlier videos. But tonight, we're going to be concluding the series, talking from a higher level about some of the details that you need to know about getting involved with apartment syndications as a passive investor. So I'm done talking for the rest of the night. I'm just here for the intros. I'm going to pass it off. I'm going to kick it like a football over to Dan and Rodney. Good luck, guys.
So you're like the let's get ready to rumble guy who just comes out, gets everyone hyped, and then
I'm Bruce Buffer. Yeah, that's his name. I think so. Yeah.
He had a good
that guy
job.
Always seemed like he had a good job. Yeah.
Yeah.
How much do you think he made doing like just 30 seconds of work?
At the end there, I mean, he was doing some pretty big stuff. Like people would call him in for events that were like not just boxing things. So I think just for random appearances, he was probably raking in big bucks. But this was like the 90s. I mean, was he still doing all that stuff like in the last 15 years?
I think we need to just pivot. I think we're doing the wrong topic here tonight, guys. I am not interested in real estate. No. I'm saying I'm not interested in real estate anymore. I think we're all going the wrong career paths. I think we should all be I'm
really curious what happened to him. I'm gonna go down a rabbit hole later and figure out what he's been up to because I've not heard him for a while.
Announcers and work on our radio voice.
He lost his voice.
Oh man, maybe that's what
happened.
Yeah.
I mean, I heard that from a guy. The guy might be me. I might be making it.
It's a credible source.
It's credible. I believe me. Anyways, guys. Okay.
So what are we talking about tonight?
What are we talking about tonight, guys? I was thinking that we could talk about. Well, in the first episode, we talked about. Yep. In part 1, we talked about what is a syndication. So we talked about how it's structured, who the general partners are, who the limited partners are, what the heck those terms even mean. We ran through the breakout of who bears the most risk, how much time is involved for a passive investor, how much returns you can make, how much control you have. And then in week 2, we talked about what value add multifamily investing is all about and how cool the value add component is. I think tonight, if you guys are up for it, I think we should talk through the step-by-step process that a passive investor can expect to experience from the moment that they sitting here right now listening to us talk, going, hey, maybe I want to do this. What comes next? And maybe walk them step by step from where they are right now, not invested into a deal, all the way to the end where they've raked in the big bucks and they're retiring gloriously wealthy.
Yeah, I think that's a great topic because so many people who are new to investing in these types of deals aren't used to the fact that there is a time element with these deals. Most investors are used to the fact that they could hop on Ameritrade or E-Trade or Schwab, and if they want to invest in something, they can click it, be in it, and they're done. And likewise, if they want to get out, they can click it, be out, they're done. But with real estate investing, there's a specific timeline where something becomes available. There's a window of time, and then the opportunity's gone. So usually you've got 30, maybe 60 days from when you are aware of a deal to where you have to have made your decisions, done your research, and signed everything and gotten all in. So that could be a little nerve-wracking for people on their first deal. We're going to dive into
parts to it that they really need to be aware of along the way.
Exactly. So being aware of that stuff ahead of time is key so that you don't find a deal and then all of a sudden find out that you've got to get all your ducks in a row in 2 weeks. I mean, that is not the way you want to make an investment. You want to be very comfortable with what you're doing. You don't want to rush into it. So, we're going to go through what the timeline is tonight so that everyone could be aware of that. And then on top of that, we're going to also discuss what Anthony and I have thrown together as like our ideal timeline for a passive investor. So leading up to when a deal becomes apparent, like how far out do you start researching and meeting people and all that good stuff. So we're gonna, do the 50,000-foot view, and then all the little I don't know, what's the word I'm looking for?
Nitty gritty details.
Not nitty gritty details.
Get your boots in the mud.
I don't know what to say. It's
here. You sit and think about that for a second. I want to point out something here.
Yeah, I don't know.
Milestones, benchmarks.
Milestones. Yes,
I did it. We got it. We got there.
Thank you.
Nice. I want to add, because if you're new to real estate investing, when the deal comes available, like Dan's pointing out, we have a very short window of time to actually raise the money and execute it. Maybe almost guaranteed it's going to be less than 90 days, but chances are it's going to be somewhere in the 60-day range from beginning to end. And the thing about these opportunities, deals aren't just falling off trees, or at least not really good ones. And so people who are aware of the power of these investments are chomping at the bit and looking for opportunities to put their money to work. And so the deals fill up quickly. And so it's a first come, first serve basis, which you might, if you're new to investing, you might want to, ease your way into it. You want to go slower, but recognize that there's a time component here that you might just miss out if you're not ready to move when the opportunity comes. And so that means you have to be educating yourself early in the process. You have to be forming the relationships with operators. You have to kind of have your money not necessarily set aside, but at least ready to mobilize within a quick period of time.
Mm-hmm. Yeah, I love it. So where do you think we should start?
We probably need to start with the operator. And because I'm not sure how deep we got in that before. But that,
the way we had it mapped out when we were putting together a quick start guide and the subsequent book that's going to be coming out is, and this doesn't need to be the way you do things. This is just kind of how Anthony and I were presenting the ideal experience to someone was, from time zero, when you first decide to start getting into real estate, we suggested 1 to 3 months you spend just on, general education around the real estate business model. Just get your head wrapped around it. And then we said around month 4 to 6, about 1 to 2 months are spent finding the operator. So we had that kind of as step 2, like learn the business model, learn the ins and outs, like basically the first episode of this series, like all the stuff we talked about there, what the heck is a syndication? Get your head wrapped around the business model would be kind of first step. So what do you think about that? Would you?
Yeah, I would agree with that.
You do? Okay. Because I like it when we disagree. Sometimes that's an entertaining conversation too. But yeah, everyone's different. I mean, sometimes people are coming into this, maybe they used to be a real estate agent, right? They don't need to spend 3 months researching the business model. But I'd say, brand new person who just read Rich Dad Poor Dad for the first time.
Yeah, I would say that understanding the process, understanding the steps you're going to be going through, how the syndication works, how to select I know that we're, the second step is understanding your operator, but in the grand understanding their part in the whole process is definitely a good place to start.
Yeah. So I got a question for you guys then. So let's say someone is new to investing in real estate and they're kind of following our timeline. They're getting into the education phase. At what point do you think that individual would know that they're ready to start to go out and networking, trying to find various operators that have the types of deals that they're trying to get into? Because I think this is a problem a lot of people face is they get stuck in that education phase and they never feel like 100% ready to actually go out and start
analysis paralysis.
Yeah. When do you think someone knows that they're ready?
I guess the cliche answer would be it's going to be different for everybody, right? Somebody's level of
I'm not going to accept that answer.
Yeah, I know. That's a poor answer, but
yeah, that's not a poor answer. It's true. It's different.
It's true to an extent, but I think that also that individual has to probably step back and say, I have a broad knowledge, because they're going to continue to learn, right? I mean, as they continue to invest and as they continue to talk to other operators, they're gonna learn more and more aspects of the business. So being what I would call 100% ready
doesn't exist.
It doesn't exist. I mean, because you're always going to find some little caveat that's going to throw some uncertainty into the whole deal. So when we talk about syndication from, let's say, an operator's perspective, and what's the first thing we're talking about is educating yourself and getting a mentor. And I don't think passive investing is that far off of that. I mean, if you can find somebody who's already in the business that you know and trust, and then talk to them, they're going to be a good sounding board to let you know that, yeah, you understand this well enough to move forward.
Mm-hmm. Yeah, I agree 100%. That was something I said it was either one of these roundtables or it was one of our podcasts, but the question was posed, like, when does someone know that they're ready? And then, my response was basically, that's a great reason, or one of the many great reasons to have some sort of mentor, coach, or just guy, that's like 5 or 10 years ahead of you, to be that, non-emotional voice of reason to say, hey, you're ready, you know enough to get out there and do the damn thing, or maybe you're not ready, do a little bit more study. So having like someone who's not you helping you understand when you're ready is key. But I think basically when someone can tell how a deal makes money, when they can look at the projections in a deal package and say, okay, this deal makes money because of X, Y, and Z, and this is a good deal because of X, Y, and Z, or maybe this is a bad deal because of X, Y, and Z, right? It might be like, oh, this has a value add component. We're able to make these upgrades that generates higher returns, and that's where this extra cash flow is coming from, and that's where this extra equity is coming from. Being able to like explain to somebody else how a deal's good, or why it's good, and actually, now that I'm saying it, be able to explain the deal to somebody else and answer your questions about it might be a good indicator.
Yeah.
I couldn't agree more with you guys. I actually wrote it onto my sheet here. It says
down. A little bit farther down.
Down.
Can't see it.
Oh, are we supposed to look at that out of focus?
It's blurry. Okay, it says mentor, and then underneath of it says teach it. So the mentor is critical. Yeah. Somebody who's further along than you, because when you're new to something, it's really hard to know if you're ready or not, and you can use that as an excuse indefinitely just to keep studying and learning, and you never really feel ready. But somebody who's experienced in the industry can usually look at somebody and after a quick conversation with them, a relatively short period of time, can say, yeah, you seem to understand this and know what you're doing well enough. And so finding a mentor, even as a passive investor, I think is always huge. And then teaching it. Can you sit down a loved one, a friend, or your dog and explain it to them in the simplest terms possible, that they start to understand it and they can start to ask questions? Because when you first start talking about apartment syndications, there's some natural questions that arise. And if you can field those and explain it to that person in a way where they're like, oh, okay, yeah, that sounds cool, then you understand it well enough. And I think that that holds true for any topic. It's a great way to learn anything, is get to the level where you can explain it simply.
Yeah, I think that's perfect. I think the element that's key there is being able to answer someone else's questions about it. I think that's like the true test of whether or not you really understand something, because you can regurgitate information that you've gathered, but if someone throws a question at you, like you're explaining it to your wife, your husband, and they're pretty green to real estate, and you get kind of tripped up, then that probably means that you need to do a little bit more studying. But anyways, that's super super helpful for people, I'm sure, because it's tough to know when you're ready. It's it's easy to look at someone else and tell them what they should be doing, but it's a lot tougher to make that kind of call on yourself for some reason. So
absolutely.
So yeah, after the first couple months of getting your head wrapped around the business model, you get to the point where you can explain a deal to somebody else and even answer their questions about it. That's based on our little timeline that we put together. Again, this could be different for everybody. That's the point where we think it's a good idea to get out there and actually start finding operators, which can be can be tricky because, I mean, a lot of these deals are private, right? I mean, not everyone is like Grant Cardone putting them on blast, throwing, 5-8 emails in your inbox every day. So Anthony and Rodney, I'm curious, how do you guys think that people should go about finding operators that that they align with?
Well, I always think
Craigslist.
Yeah, there you go. Always reputable.
Yeah.
I mean, word of mouth is always the first place I go.
Yeah.
What are people that I know doing, and talking to their experiences, and how have the returns been compared to what was in the investor presentation? Does it align with that?
Mm-hmm. Yeah, no, I'm with you on that. I think the good old fashioned networking is the way to do it. Partially because, like I said, a lot of these syndication deals are structured in a way that legally operators can't just go out and put a commercial on TV or run Facebook ads and say, hey, we've got 123 Main Street project available for you to invest in. So a lot of them are structured in a way that there has to be a pre-existing relationship of some sort. So you've got to already know the operator before the before the deal becomes available. So good old fashioned networking. And, like you said, Rodney, it's, you could just start Googling operators too, but being able to have some kind of referral to this person, or, have some kind of references, especially if it's from someone that you already know, is going to be huge. So
LinkedIn is a great resource.
It is. I feel like you don't get as many weirdos on LinkedIn as you would on Craigslist. But
another way, so not to like directly sell ourselves here, but as you're going through the education process, you're probably going to be reading books, you're listening to podcasts, sitting in on roundtables like this one. You're going to be watching videos on YouTube, just consuming a bunch of educational content. And those operators presumably could be really good resources to talk to. Maybe you don't necessarily want to invest in the markets that they invest in. So you might look at, one of the big names guys that has content everywhere, and then say, I don't really want to invest in those markets. I want to invest in this market. What you could do is you just reach out and say, hey, I love your content, been consuming it. I'm interested in investing in these markets. Do you know of any operators in this area that you would recommend? And that's like a way to get word of mouth referral. And I'd say the educational side of things is what we heavily focus on in what we're doing. The reason that we're doing this right now is to spread the word, because we want as many people to be empowered to take action in this field as possible. You might not be interested in investing in the markets that we're in. So Rodney, you're in Alabama at the moment, in Tennessee, and we're up here in Minnesota. Right. And you might really like what we have to say, but you're not really interested in those markets. And you say, I want to invest in Austin. Reach out. We know people that invest in Austin. Mm-hmm. We can connect you. So that might be a way to do it.
Yeah, it's a really good piece of advice. And I think that it's true across the board as well, not just with us, because pretty much everybody I've met in this business is very selfless and helpful, and not really of the like scarcity mindset and in like competition mode with other operators. Like everyone in this business seems to realize that there's plenty of deals out there, and there's way more, capital out there than anyone could ever put to work. So, if someone comes to me and says, hey, Dan, I'm really interested in investing in Nashville. I came across your stuff. Not really into the Twin Cities. I'm not going to try to hard sell them on investing in the Twin Cities, because it's,
that's my
not
job.
A good use of my time.
He'll send you to me.
Yes. Yeah. You're the hard sell.
Twin Cities for life.
But yeah, I mean, there's no incentive for any operator to force somebody into one of their deals. Because, there's just, like we said before, these types of projects are very popular, and when they pop up, they fill up quickly. So it would make no sense to try to hard sell someone into one of our deals, and they don't even want to be in there. So then, after a couple of months, we've got an investor who isn't happy. Makes no sense. So you could pretty much hit up just about any operator. I'm pretty confident and say, hey, who do you know in X, Y, and Z market or in X, Y, and Z asset class? And they'll be able to give you at least a couple of names, guaranteed.
Exactly.
Very
Absolutely.
Good. And then one other thing we should point out as well is, while you're going through the education process, getting your head wrapped around the business model, you also want to identify specific investment parameters and specific investment goals you've got for yourself. And then you want to make sure that those operators that you locate are in line with those goals. So this could mean maybe you want to do value add deals so that you can maximize how much equity you're creating, how much wealth you're creating, or maybe you're just really focused on cash flow. Like you're a little bit older, not trying to grow your wealth as much. You just want big cash flow from day one. And that's kind of your goal. So identifying those things while you're doing your education, make sure your operators that you find are in alignment with those as well. Very important.
Mm-hmm. Yeah. So if you like you're pointing out there, if you want cash flow, that's going to be a different investment than if you're looking for big appreciation and something in the value add. And so as you're doing your education, a big component of that is understanding your investment parameters. And as we just talked about, your market, like where do you actually want to invest and what asset types and classes? Is it multifamily? Is it storage units or mobile home parks? And then that's going to dictate the operators that you're naturally going to gravitate towards and have the next step conversation, which is, hey, I'm interested in creating a relationship with you, talking about like your process, your deals, and maybe getting on your list so that I can be privy to future opportunities.
Mm-hmm. Yeah, I love it. So yeah, basically, 1 to 3 months educating yourself. And after that, 1 to 2 months networking with operators. Once you find some that fit your parameters and that you align with philosophically and jive with, then you're on their radar, they're on your radar, and at that point you just kind of keep your eyes open for deal flow. They'll send you opportunities when they become available, and typically I think most operators do a few deals a year. I don't know, big guys like Ken McElroy might be hammering through a lot. But I think most operators that we know are doing, 2 to 5, maybe 6 deals a year. So, once you kind of find your guys that you like, give it a couple months and things will start popping up. But then when something does pop up, the clock starts ticking. So
it's exciting. Oof,
yeah, let's dive into that. Once you find your operator and they send you a deal, what happens? You get a deal package.
Your eyes bug out. You go, whoa,
yeah,
what
lots
is
of
this?
Information, lots
I'm
of
overwhelmed.
Opportunities, lots of questions.
So now is when we start looking at what the offering is.
Mm-hmm. Yeah. So when that hits your desk, I think it's safe to say that there's probably less than 60 days for you to do everything. So let's get into what everything is and at what
at this juncture, the first step is you're going to get the investment package and just kind of outlining generally the deal. And that's going to vary depending on operators. It might be a really in-depth, high quality offering that looks really well done. It might be just a single page with some details of the returns and the property. And so the first thing you're going to look at is, okay, does this actually fit my investment parameters from a high level? Does it generally hit the asset class, the asset types? If there's return information in there, then is it actually hitting my minimum returns that I'm looking for? And then most operators are going to either do a webinar where they're going to try and bring in as many investors at one time as possible to sit down and have a conversation and walk through the investment offering and answer any questions that you might have. If you can't make it to that, some operators will do one-on-one phone calls, talk you through it. They might do dinners. I've heard some people doing that, but not these days during COVID life. So you're going to eat alone.
Doesn't sound fun.
I mean, COVID. What about COVID has been fun?
Well, I mean,
I've enjoyed it. I've enjoyed a little bit of it. I'm a loner.
Yeah, the first few weeks I wasn't complaining, not gonna lie. So yeah, usually you're gonna get the package and or the webinar or the presentation or something. That's usually going to be kind of the first thing that you get. And after that, if you're interested, you're going to express that kind of interest in what's called like a soft commitment. Basically, you take a look at it, you crunch the numbers, and let's say you decide to move forward. You let the operator know, hey, Anthony, I like this deal. Let's say the minimum's 50K or something. I want to put in 50. I want to put in 75. That does not save you a spot in line. That's what's called a soft commitment. That is you saying, hey, I'm into it. Send me the PPM. Send me, the docs.
Oh, PPM. What does that mean?
That's a good question.
Aha.
Private placement memorandum. And
so if I give a soft commitment and I get a PPM or a private placement memorandum from the operator, am I guaranteed a spot yet?
No.
Well,
hard no.
Maybe it depends on the operator. If they say, hey, I'm guaranteeing you a spot, then maybe it does.
Sure. Because the operator does have some latitude, like let's say that, and this is not across the board, but I've seen operators with $75,000 minimum and you got 50. They can make the exception. Doesn't happen all the time, but they have that latitude because it's their deal. They're running the deal. But yes, when you get the PPM and you made a soft commitment, the time is ticking, and until they actually get your money that you're going to invest, you're not guaranteed a spot.
Yeah, that's true. That's an important distinction as well, because sometimes people will, fill out the PPM, sign it. They'll do all the paperwork and they'll send that in thinking, okay, I just signed this, right? That felt pretty official. Here you go. It isn't until the funds actually hit the bank that you are fully in. So again, that could vary per operator as well. And if the operator is your brother or your sister, they'll probably give you a little leeway there that might actually save you a spot. But realistically,
why is the soft commitment even important? Why is that even a thing we do?
Well, it does let the operator know that they have interest out there. But as an operator, I don't think that I would sit on that soft commitment as a sure thing that I have, I've got $100,000 over here from Joe. He's soft committed to it, and therefore I only have another X number of dollars to raise. A good operator is not going to sit on that either. But it does let him know that he's got interest and he's making traction. Do you guys have other pieces to add to that?
Yeah, I think that puts it into perspective. In general, you're not going to collect 100% of the soft commitments people make. You might get 50%, you might get 70%, but it's almost assured that you're not going to get 100%. And so the soft commitment can be a valuable metric for an operator to say, how close are we to the goal, and kind of benchmarking that. Are we wildly off? Are we way under? Are we significantly over? And are we going to be okay making it across the finish line? So it really signals to the operator that you have interest, but then this is how maybe close or far away they are from actually getting the deal done.
Yeah. I'm, kind of in Rodney's boat as well. People will tell me what they're interested in investing, and I say, okay, great. I'm excited for you. Thumbs up. However, it's first come, first serve. So, we might be friends and everything, but if people pile in, it would be unfair for me to turn them away because you said you were going to do something. So, I always let people know that when they say they're going to do something like that, I'm always very clear. Okay, it is first come, first serve. Nothing personal, just business. If people beat you into it, it's the breaks. So, sometimes I'll give a little leeway to someone who's working on like an IRA transfer or something where they don't necessarily have control over, how long something might take, something like that. If it's IRA funds, I know they're transferring them. It's not like they're going to go spend their IRA money on something else. So those guys where it's something a little bit more administrative that's slowing things down, I'll give them a little leeway on. But if someone's just kind of, hesitant to actually pull the trigger or slow to communicate, it's like,
yeah, if it's a guy that's done 5, 6, 7, 8 deals with you, that relationship
exactly
goes a long way.
Mm-hmm. Yeah, and I mean, we're all smart guys. I can tell when someone is procrastinating because they're nervous and unsure, or if they are just trying to transfer funds from one bank to another, and it's going to take 5 days. So.
Yeah, and it should be pointed out here, though, that that's a thing that we can say as operators, that we would, if you're doing a self-directed IRA transfer, we would be lenient and trying to work with that. But that's not necessarily the case for other operators, specifically as you get into like larger and larger operations where it might be a real race to get the money in there. And they might just say, oh, tough nuggies, you didn't get it in fast enough, regardless of the reason for it.
Yeah. Another bonus to, finding operators that are kind of in your network that you have some kind of connection with, and not just going with the biggest guy in town where you're just a number, going with somebody who you actually have a relationship with outside of just the investment partnership. Mm-hmm. So,
yeah, that's one aspect of it. The other aspect of it then is if you're going to do like a self-directed IRA or, something that's going to take a little bit of time to liquidate and move the assets over, maybe have that ready to go and already have built those relationships with the intermediaries or, your broker, so that you can actually execute it really quickly. Because if you wait until the deal appears to start talking to the self-directed IRA guys, that's going to take a couple of weeks, and it's not a lot of work, but it's going to take time. And it might be time that the operators just don't have to sit waiting on their hands for the money to come in.
Yeah, no, it's a very good point. Figuring out what some of those bottleneck things could be, some of the administrative things that could be time consuming, and getting those done ahead of time. And I don't think like the self-directed IRA portion is all that time consuming. I think the more time consuming part could be just consolidating your 6 random 401ks that are scattered all over town, and random institutions that still require you to send a request in via fax to transfer funds. Like those kind of
what's a fax?
Yeah, I did have somebody say to me the other day, "Send me a fax."
And it's archaic technology.
I'm like, do you not accept an email? A PDF? I mean, I have to go find a fax machine.
I know, it's like asking someone to page you. It's like, what?
Yeah.
No, I'm not.
So no. I've done my education. I've looked for an operator and found somebody that I'm interested in. He came up with a deal, sent me the information. I watched the webinar. I've got the PPM, and I sign it.
What is the PPM? I think we glossed over that real quick.
No. We went over that. We went over all that.
Private placement.
We probably have actually at some point, but unless I blacked out, I don't think we talked about it tonight.
So we talked about what a private placement memorandum was, but we didn't actually talk about what was in the private placement memorandum.
Words. Lots of words.
Yeah, yes. Magic.
Like
sorcery.
Sometimes 100+ pages.
Yeah. Basically, it's operating agreement, disclosures, basically
subscription agreement. You're going to have the accredited investor qualifier form, and then,
you're going to have
pretty much what's going to be in the
you're going to have the operations team, or the general partner team is going to be in there. There's going to be bios about them. There's going to be it'll explain the property. It'll explain that this is a risk, that
there's going to be a big section on risk.
Yep, that there's no guarantee of any returns. We talked about how we want to select an investor an operator that can what's the word I want, follow through on what he's talking about, right? But at the same time, you have to understand that like COVID-19, those are unexpected things, but a good operator will also have some things built into where they can operate around those, but it's still not a guaranteed return. You're not putting your money in an FDIC insured instrument here. You are putting it in a vehicle that has risk. And so the PPM explains that you understand the risk going into this.
Mm-hmm.
Yeah, when we did a podcast with our SEC attorney, Zach Robins, a few weeks back, he said something really interesting, which I liked a lot. We asked him what the most important part of a passive investor's due diligence process should be. And we were fully expecting him to say, oh, the PPM, right? Because it's his job to put together PPMs for operators. But he actually said, okay, vetting the operator, and that second step, basically after your education, when you're out finding operators, vetting the operator and making sure that the operator is aligned with you philosophically, morally, and is also aligned on your investment parameters. That's the key part. And Anthony made the good point of saying, like, the PPM is basically setting the ground rules for the deal. Doesn't mean that anyone has to follow them. So if you don't properly vet your operator and you end up with a shady guy, it doesn't matter if he has like the best PPM in the world and it's so structured to be perfect for the investor. He could just be shady guy and screw people over.
Yep.
So you want to really prioritize vetting your operator, and then have a lawyer just take a peek at the PPM for you. Make sure there's nothing weird in there. But by the time you get to that PPM, you should have essentially done your due diligence. And I usually just tell people, have a lawyer review it, because it is a lot of jargon and you're not really going to get a ton out of it unless you are really fluent in lawyer speak. So, read through it. It's important. But by the time you get that in front of you, you should have already thoroughly established that Joe Schmo who's running the deal is actually a good guy.
Yeah, exactly. Because it goes back to that risk factor, right? And you're putting your money into some place that you don't have control, and you are relying on that operator to do the right thing to make the business, because you're investing in a business, perform.
Yeah. Well, I think you do have control, and you exercise that control when you are vetting the operator.
Absolutely.
I think that's kind of
once
where
you turn that
your
cash over, you're trusting that operator to handle that cash properly.
Exactly. Yeah. So, again, that kind of speaks to why it's important to, when you find your operator, maybe go in because someone has worked with this individual. And if that's not the case, ask them for references. Every operator out there who's done a deal before should have at least one investor that they've worked with who can talk to what their performance is like, what their communication's like, and just what the overall experience was like. And I think that's a very important step. So,
what if they're a brand new syndicator and they don't have any investors?
They should be able to have some other kind of track record or character references, or someone to basically vouch for them as a person. So maybe they haven't syndicated a deal before, but they should be able to prove to you that they are moral and ethical. And
I actually know that there's many people that will not invest in somebody who hasn't done at least 3 deals. And so then, it's from an operator standpoint, you're like, well, how am I going to get to that point of 3 deals if I can't get investors that'll invest with me?
Family and friends.
Well, this goes back to the mentor thing, right? So if you partner up with somebody who does have that track record carries over to you. So when you are talking to an investor and they say, well, what kind of track record? Well, my partners and I, you may hear that language, my partners and I have 2,000 units and we added an additional 1,000 units last year, or whatever the case may be, hypothetical numbers, right? So that's one thing a passive investor can look for, is the track record of all the partners, because one of the partners, or the one you're talking to that might be your friend, or may not have a track record because this might be his first deal. But if he's partnered up with somebody who does have a track record, who's successful, then you can be assured that to a reasonable point that you're in good hands because of the track record of the other person that you're in business, that person's in business with.
Yeah, it's true. I think it's rare that one guy is bringing everything to the table.
Very rare, because this is a team sport.
Yeah. Sure. Yeah.
It's I would say, if you are looking at an operator, Well, okay, let's back up actually. As an operator, if you want to get into apartment syndications and you're brand new, like more power to you. I support you. As Rodney's pointing out, finding the right team is going to be critical. If you can find some people who have experience and kind of ride a little bit of that coattail of like getting lent credibility through that, that can be really powerful. If you don't, if you have a partner, let's say, who is also brand new and you guys are like, hey, we could do this thing, I would highly suggest that your first experience in real estate not be a syndication. I would say you should look at joint venturing or some other means of getting into a deal to understand and build that experience. Don't just jump into taking other people's passive money. That is a recipe for disaster. And so if you're a passive investor looking at an operator and they're like, I've never done this before, I have no real estate experience, but I'm going to do this syndication. Here's my partner. He's also new. I would pump the brakes really hard. If they're like, hey, yeah, we've done a couple of joint ventures over here. We have this track record. We've done this. Okay, it's all right. Maybe that you're new. Like, I'll give you a little bit more credibility there. But if you're brand new, fresh off the boat, I would be very, very hesitant if they've never done a real estate deal. And if they have done a real estate deal, but they haven't done a syndication, then that means that they have some professional references or some professionals they've worked with that should be able to vouch for them. Whether that's, hey, I've worked with this broker in the past, or this lender in the past, or this contractor. Hey, go talk to them and they'll talk and tell you how I am, how I operate. Does he pay his bills on time? Is he communicative? And that can be maybe a little bit of the referral that you need if you don't have passive investors that you can just point people to.
Mm-hmm. Yeah, I love it. I think the lender is a key one as well. Because they're going to be probably the most
stickler and experienced.
Yeah, I was just going to say the most cognizant of whether or not somebody is a safe bet, right? Because the bank wouldn't be giving an individual money if they didn't have faith in what they were doing. So that I guess, based on my experience, if I had a lender telling me that, Anthony over here is making some good deals, then I'd be like, okay, I like it, because banks make sure they do their homework and they underwrite. So, back to our timeline here. So you find your deal with your operator, you like it, you give them soft commitments within a week of seeing the deal. You get your PPM. Typically the PPM shows up like a week after that. So it's around like 2 weeks after that very first preview of the deal. If you express interest, that PPM shows up, and then you've got about a week, typically, maybe a little bit longer. Every deal is different, but on the short end, it's going to be a week, maybe 2 weeks to kind of get your ducks in a row, read through it, sign it, send it back, and wire your money as well. And then typically, at least the way we've done it, we have our hard cutoff for investments a couple weeks prior to when the deal is actually going to be closing. So, start to finish, I'd say 60 days tops. I think in our little timeline, I've got like 42 days.
Yeah. So real quickly on that one, we like to have the funds in the bank ready to go 2 weeks before closing, let's say, because we don't want to be waiting at the closing table at the 11th hour to make sure all the funds are coming in. You just hear so many horror stories about that. It's so easy for wire transfers to kind of just disappear into the void. Nobody really knows where they're going. And so getting those funds into the bank well in advance so that we can sleep easy going into closing is critical. Some operators will push that even further forward and say we want it in there like 3 weeks in advance, let's say, which means the downside of that is that your money's kind of sitting there not really doing anything. It's dead money. And so some operators will offer just a simple 1% return on your money while it's sitting there. But that's the big reason. Like, we want your money as soon as possible so that we know we have it. We don't go to the closing table and suddenly we're short. That's worst case scenario.
Mm-hmm. Yeah. Yeah. So, I mean, that's kind of the nitty gritty of it. And that's something that I don't think a lot of new investors are aware of, that when you see that deal, that first deal that you're going to be investing in, you've got, about 3-ish weeks to really do your homework and pull the trigger. And might not sound like it's very fast, but when you've never done a deal before and all of a sudden you've got to decide whether or not you're going to move 50, 100, 200 grand into something, 3 weeks goes by real fast.
Like that.
Yeah. And especially if you're waiting on a lawyer to review the PPM, they'll probably take like 3 days. You might send the operator a question or two back and forth, that right there, that eats up about a week. So it goes by fast. So I think, really getting your head wrapped around the business model is key, so that when you see that deal, you are really confident that it's a good deal and you can pull the trigger without sitting there, thinking and asking a bunch of people and being like, oh, wait, what if this isn't right? You want to be able to look at something and be like, this is the unicorn deal I've been waiting for.
So we get the PPM in and we send them the cash, and then we're closing. Now what? Is this where the fun starts?
Yeah, I mean, everyone's going to run deals a little bit differently, but the way we've done it, and I'd be curious to hear what you've done as well, Ronnie, is, we'll send out a communication to everybody, usually like, the day before we close, just to be like, okay, closing date is coming up tomorrow. That's still happening. Nothing's changed. And then as soon as we do close, as soon as we leave the closing table, either that day or the next morning, we'll send out an email just letting everyone know, like, hey, we closed. And then just a quick little reminder of, what the business plan is, what our priorities are in the first couple of weeks, usually just, communicating to the tenants, new management, and then reiterating whatever the first action items are for the deal. And then we've always done value add stuff. So we'll send out monthly updates throughout the first period of the investment, just because there's a lot of things going on. And then as that value add component starts to get worked through, we go down to like quarterly updates after that. But yeah, that's what our communication looks like once we get to the closing.
Yeah, we're similar. We communicate when we've closed. We are communicating every month with the investors to let them know that we're on plan. Distributions typically start 6 months after closing and then occur quarterly after that. We still communicate monthly with our investors to let them know that we're staying on plan, let them know if there's anything changing, new news, so that they always feel like they're in the loop, and that's tend to work well with for us.
Mm-hmm. Yeah, I think a lot of investors should also be aware that, at least with us, I'm available for text messages, emails, phone calls, all that stuff, like whenever. I think a lot of people kind of assume that if they send in questions, they might be like bothering us or something. But the way we manage our deals, I know pretty much all the metrics off the top of my head at any given time. Someone could shoot me a text and be like, oh, what's occupancy, or what are our collections looking like for the month? And so it's no work for me to respond to that kind of stuff. So for any investors who are watching this, like, don't hesitate to ask questions. I think most operators enjoy answering the questions as long as things are going well. If things aren't going well, maybe people aren't excited to get questions, but I'm always excited because people are like, how are things going? I'm like, actually, considering all the, COVID lockdown, all that crap that's been going on, like, things are going good. So
yeah, I'm the same way. I welcome the investors to call me anytime. I want to answer their questions. I don't want them to be sitting out there wondering what's going on with the deal, especially when there's something like this, like our current situation that comes up. So yes, I am. It's never a bother, and I would rather somebody call me, text me, whatever they're comfortable with, to ask any question they have. No questions dumb, because everybody's in a different stage, and I think communication with the investors is paramount. I mean, they're why we're here.
Yeah, exactly.
And it's fun.
Absolutely.
It is.
We like the education side of things. Like it's a guilty pleasure. Honestly, you're indulging us and allowing us to talk more about the thing that we love and enjoy. It's a passion. So,
and it's good for the relationship too. I mean, how's it going? What do you know?
Yeah, I enjoy it. I feel smart when I'm talking about it. So a little ego boost for me. People ask me questions. I'm like, oh, well, actually, I have an answer for you. Here you go. Makes me feel good. Accomplish something. So yeah, I think those are basically the communication intervals. And then also I had some notes here that, we'll obviously communicate if there's a capital event or, if we're doing a refinance.
Capital event. And what
that'll usually fall out. What's that?
Capital event. What might that be?
It sounds kind of daunting, but they're good events. Like a refinance, that would be a capital event. So, a refinance might not fall right perfectly on a quarterly update, right? It might just be kind of in the middle of things when we happen to do it. So there would be an update that would shoot out when we're kind of gearing up to do a refinance and or a sale, right? So those would be the other communications that would come out if we're planning on doing any of those things. But
so I've bought into your syndication. I've invested with you. We've been in this deal now for, let's just say 5 years. And it talked about a capital event like selling. So asset is sold. Now what?
You get a big fat check in the mail or an ACH deposit or a wire, something different for everybody. That's the fun part is the capital events is, the cash flow is nice throughout, but when there's a refinance or a sale and there's a big influx of capital, that's always fun. But yeah, if it were a sale, then basically the entity that owns the or that owned the property would just be dissolved, and 123 Main Street LLC would cease to exist after that. Everyone gets their capital back and goes their merry way.
Now, you said refi also. So if let's say that I invested with you and I put $50,000 in your deal, and you bought this great deal, and 3 years into the deal, you do a refi and I get $50,000 out of the refi. Now, am I done now that you've returned my capital, or what is my position in the investment from that time until we sell?
It depends. There's a multitude of different ways you can structure deals. The way we've always structured our deals is if we do a refinance, the investors keep whatever equity share they had to begin with. And, let's say you put in 50 grand, 3 years later, we do a refi and we return 50 grand to you. Well, let's say on day one, when you first invested, you had, like a 7% equity share. Like you would still have that 70% equity share. Even though you've gotten all your money back, you still have that same equity until we actually sell the deal. That's how we do it. I know that there's groups out there that when they do a refi, they essentially kind of buy out the investors, and as they return capital and that capital account dwindles down, that investor's equity also dwindles down. You can structure these things any way you want. I think the way we do it's a little bit more popular from what I can tell.
Yeah, that's the way we do it as well. You retain your equity stake in the deal.
Yeah, but that's a very good question, because I don't as an investor who's kind of newer to this, I wouldn't assume that that's the case, and that's something you would definitely want to ask about.
That's my point exactly, is that you need to make sure going into the deal that if they do a refi, that you get to stay in because that's where you want to be. You want to stay in the deal, maintain your 7% or whatever your percentage is, and then be able to take and put that capital work again on another deal.
Mm-hmm. Yeah, and typically what will happen as well is, and we didn't have this on our last deal, but what is more common is as that capital account dwindles down, even though the investor's equity position in the deal stays the same, their preferred return will go away. which usually doesn't matter when you're 3, 4, 5 years into a deal anyways, because you're probably going to be maintaining well above whatever that preferred return was anyways. But technically, it's not uncommon at all for people's preferred return to go away. That doesn't mean that they don't get the same amount of money. It just means that the general partners are getting paid at the same time as the LPs, where previously the LPs would.
What preferred return is? I don't think we did.
No, but that would be a great next episode.
Nope, this is the end of the beginner series.
Yeah, in a nutshell, I kind of explained it there, just not really straightforward. A preferred return is essentially a return that a passive investor gets before the general partner starts to take any of their portion of the profits. So if a investor in a deal is getting a 7% preferred return, that means the investors in that deal need to get that 7% return before the general partner starts to take their share of the profits. So maybe it's like a 75-25 split. Investors get 75% of the profits. GPs get 25%. The GPs wouldn't get their 25% of the cash flow until the passive investors got their 7% return. Then after that, everything's split 75-25.
And as a passive investor, I would recommend that if you are going to invest in a syndication, that's one of the things you look for, because that's a metric that's based on performance, which means that that the operator will need to make the asset perform before they get paid.
Mm-hmm. Yeah, no, I think it's a great way of putting the investor first, right? They're first in line. The first dollars of profit from operations go to them. So I think it's a great strategy. It's win-win. It lets the investors know that they are prioritized, and it, like you said, it incentivizes the operator to really get that thing running like a well-oiled machine as soon as possible. So
absolutely. Well, I think we got everything covered.
We finish it, start to finish.
I think that's everything. I think it'd be a really good topic for a future episode if we go into the capital stack and returns and talk about that a little bit more in depth, because I think there's a lot of nuance there. But, if you're a new passive investor to apartment syndications, I think at this point you have enough of a high level understanding of what a syndication is, how the value add model works, and then what's the expected timeline that you can start to wrap your head around all the different concepts that start to weave in and out of here.
Mm-hmm. Good deal.
All right, guys. Well, I got one little tidbit for you guys that you're going to be really interested to know. Bringing this whole episode full circle. So Bruce Buffer is actually Michael Buffer's brother. Michael Buffer is the Let's Rumble guy. Guess how much Michael Buffer is worth?
I'm going to say 200 million.
Rodney, would you like to guess? I was not going to quite hit that high. I was thinking more 12 million.
Okay. So Bruce Buffer, who is also a ring announcer, is Michael Buffer's brother, and Bruce Buffer is worth $10 million. Michael Buffer, the Let's Rumble guy, is worth $400 million.
Wow.
Oh.
Yeah. So
do you think there's any brotherly competition going on there?
They're half brothers, actually. I guess they didn't even meet until like the late 80s.
Wow.
That's hilarious.
All around Let's Rumble.
Yeah. I wonder if you could.
It's trademarked, so we can't say it on the show, just so you guys know. We can't say the full thing.
For next week's episode, it would be great if you could find out how much he charges to show up and say that at an event.
Generally between 50 and 100,000, but he's been paid up to $1 million for one showing. Yeah.
Okay. Because I think I saw.
But he's trademarked it, and so he leases it out to like video games and movies and things like that.
That's how he got up to 400.
That's pretty good that he was able to trademark that thing, and that the whoever was paying him didn't snag it. And
good for him.
Yeah.
So Follow your dreams, guys. If passive
I'm
investing in
gonna
apartment
guess-
syndications doesn't work out, this is the way.
I'm gonna guess he's got a little bit of real estate there too. I'm gonna guess.
I would
I can
bet he
guarantee that.
does. I would bet he does.
Yeah.
Well, hey guys, next week we have a guest by the name of Yona Weiss coming on, and he's going to be talking to us about cost segregation. And so make sure you connect with us next week. If you like what you hear here, smash that like button, hit subscribe and the bell so you get notified anytime we put a new video out. And we look forward to seeing you next week.